When you die, your debt doesn't just disappear, and your family doesn't automatically inherit it either. But here's the thing. Most people get this completely wrong in both directions. Some think their loved ones are on the hook for everything. Others think all debt just vanishes the moment you're gone. The truth is a lot more nuanced, and knowing it could save your family from making a very expensive mistake. Let's break down exactly what happens to your debt when you die. First, the most important concept you need to understand: your estate. When you die, everything you own, your bank accounts, your property, your investments, becomes what's called your estate. Your estate is also responsible for paying your debts before anything gets passed on to your heirs. So if you have $10,000 in credit card debt and $50,000 in savings, your estate pays the credit card company first. Your heirs get whatever is left. That process is called probate, and it's managed by whoever you named as executor in your will. If you didn't have a will, the court appoints someone. Now here's where it gets really important. Your family members do not inherit your personal debts just because they're related to you. If your name is the only name on that debt, it dies with you. Or more accurately, it goes to your estate. But there are exceptions. And this is where people get tripped up. The first exception is joint debt. If someone co-signed a loan with you or is a joint account holder on a credit card, they are 100% on the hook for that balance. This isn't inheritance. They were already legally responsible the moment they signed. The second exception is community property states. If you live in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, the rules are different. In community property states, debt taken on during a marriage may be considered shared debt, even if your spouse never signed anything. If you're married and living in one of those states, this is something you absolutely need to know about. The third exception is when someone pays a debt they didn't have to. Sometimes grieving family members pay off a deceased person's debt out of guilt or pressure from collectors. Here's the hard truth. If the debt was only in the deceased person's name and the estate has no assets, creditors may get nothing. Debt collectors know this, and some of them will call grieving family members hoping they don't know their rights. You are not legally required to pay a debt that wasn't yours. Now let's talk about which debts survive death and which don't. Secured debts, like a mortgage or a car loan, are tied to an asset. If your estate can't pay the mortgage, the lender can foreclose on the home. If an heir wants to keep the house, they typically need to assume the loan or refinance it in their name. Unsecured debts, like credit cards, medical bills, and personal loans, are paid from the estate's assets. If the estate runs out of money before all the debts are paid, most unsecured creditors are simply out of luck. Federal student loans are discharged upon death, meaning they're wiped out. Private student loans are trickier. Some lenders discharge them, others don't, and some will go after the estate or a cosigner. So what can you actually do to protect your family? Number 1, keep a clear record of all your debts and accounts. Your family shouldn't be discovering surprise debts in the middle of grieving. Number 2, be very careful about who you ask to co-sign anything. When you put someone's name on a loan, you're handing them a potential liability. Number 3, beneficiary designations matter more than most people think. Assets with named beneficiaries, like life insurance policies and retirement accounts, pass directly to that person and are generally protected from creditors. That means the money bypasses probate entirely and goes straight to who you named. Number 4, if your estate might be insolvent, meaning your debts outweigh your assets, talk to an estate attorney now while you still can. There are legal strategies to protect your family from being left with nothing, or worse, being pressured into paying debts they don't owe. The bottom line is this: your debts don't vanish, but they also don't automatically become your family's problem. The difference between those two outcomes often comes down to how well you planned. This is general information, not legal or tax advice. Consult a professional for your specific situation. If this helped you understand something most people never think about until it's too late, subscribe to Fine Print HQ. We break down the legal and financial fine print that actually affects your life every single week.